So I wrote or penned an article, as they were we used to say back in the day, on basically the relative valuation gap between small caps and large caps, whether there's an opportunity, and I highlighted the CAPE ratio, and I made a very punny title there: captivating predictions. Small caps ready to outshine in a pricey market. So very, very punny there. And there's my AI generated image. Is the cyclically adjusted price earnings ratio predictive hero? Of course. So just over halfway into 2025, I'm going to briefly look at the current broader market valuations where the opportunities may be presenting themselves. But what is the CAPE? Well, it is the cyclically adjusted PE ratio, also known as the Shiller PE. One metric, we utilize it internally and quote it to clients as a broad gauge of current market valuations. It's also known, like I said, as the Shiller PE. It's a valuation metric popularized by American economist Robert Shiller. Unlike the traditional trailing PE month ratio, 12-month ratio, which can be distorted by short-term earnings fluctuations, the CAPE ratio smooths out cyclical effects by dividing the current price of an index, say the S&P 500, by the 10-year average of its inflation-adjusted earnings. This methodology provides a more stable and long-term view of market valuations, making it a valuable tool for forecasting potential future returns and evaluating the current valuation in a historical context. Historically, a higher CAPE ratio has correlated with lower returns over the subsequent decade or two, as the ratio tends to revert to its mean. So let's just look here at some numbers I pulled. As has been the case for the majority of the past decade, the S&P ratio remains significantly elevated, the S&P 500, when compared to its historical averages. As of mid-July 2025, the Shiller PE on the S&P 500 is 37.8. This represents an increase from where it was at 2 months ago of 35.2, and about a year ago where it was at 34.8, indicating continued upward movement in broad market valuations. For historical context, the 20-year average for the Shiller PE ratio is 27. The current CAPE of 38.8 or 37.81, I could speak, is 40% higher than its 20-year average. The all-time average over the last 100 plus years for the Shiller PE is 17.6. The current CAPE is approximately 114% above its all-time historic average. So now I note something here that we have been pointing out to clients since the mid-2023. Large caps represented by the S&P 500 continue to trade at a significant premium over small caps represented by S&P 600. It's currently around 42 there, close to the peak for this cycle. And it's widened from the peak. It was around 50 in November of 2023. And it's widened from 36.7 at the start of fall in 2023. So what are the implications of current CAPE levels for future market returns in reality? The CAPE ratio is not only significantly above its 20-year average, but also exceeds its long-term arithmetic mean, which was, again, 17.6. That's over 100% above that level. The current deviation, the significant deviation, implies, based on historical patterns, the broader market could be considered overvalued. The core principle of the CAPE ratio is its inverse correlation with future long-term returns. A higher CAPE suggests lower returns over the next 1 to 2 decades. As we said, this indicates that investors should adjust their long-term return expectations for the broader U.S. markets, equity markets, downwards. Relying solely on passive index strategies such as index ETFs or funds in such a high CAPE environment may lead to subdued real returns over a multi-year horizon, necessitating a more discerning approach to portfolio construction. The current market firmly set up as what we would call a stock picker's market. Near to midterm, it appears to be this type of market where identifying high quality, fundamentally strong, small and mid cap companies can yield significant long-term returns. Recent examples of this, we've highlighted these on the show a number of times now, are picks and shovels play on AI and electrification Argan, which has jumped around 345% over the past year alone from our recommendation of around $50 this time last year to where it trades at around $320, or is it, sorry, $220 today, in that range. Unknown and profitable company called Prodex recently recommended to clients. About 18 months later, the stock was up to from about the $16 range to $52. These are examples of high quality small cap names that traded at a discount to their large cap brethren that we were able to identify and clients were able to profit from. Now, this persistent elevation of the CAPE ratio has naturally led, the persistent elevation has led to discussions about whether structural changes in the economy, such as sustained low interest rates, technological dominance of a few large firms, or efficient capital allocation, justify what we always call a new normal. You hear that a lot, of higher valuations. However, the CAPE's historical predictive power and its consistent tendency to revert to the mean suggests that such extreme deviations are historically temporary. Let's take a look quickly at the updated forward PE ratios for U.S. market capitalizations here, comparing the updated S&P 500 forward PE of 22.48 with the S&P 600 small cap forward PE of 15.8 reveals that large caps still traded a significant premium on this basis, about 42.28%, while the premium has narrowed slightly from what we saw at greater than 50% in November of 2023. It remains a substantial deviation from the first 20 years of this century, where small caps traded at a premium. This sustained, albeit slightly reduced premium for the large caps indicates that the underlying market dynamics favor large cap outperformance, such as concentrated growth, perceived safety, continue to exert influence, preventing a full mean reversion to historical small cap premiums. The narrowing suggests some revaluation or rotation within the market, but the fundamental imbalance persists. The continued valuation discount in small caps implies the opportunity to position our clients in high quality, undervalued small caps remains. So that's what we continue to do. Only high quality names, growth at a reasonable price with solid balance sheets. And there's the disclosures, and that'll end my segment. If you can catch that or grab that full article on our website at www.keystocks.com as well.
Yeah, I've definitely been seeing a lot of people saying, new normal being tossed around just with, the increase in AI here. I was listening to a podcast, I believe, not too long ago. I believe it was actually Brett that put me towards it. And, that's just what the one individual was indicating, is that, the market may start to demand, a couple turns higher of, a multiple because of AI. But again, if we're looking historically, we've heard that time and time again, and it doesn't hold up.
Yeah, we heard that with the advent of the internet and, the proliferation of the internet. And, it looked like it for a moment and then reverted to more mean long-term historical average.
Exactly.
One thing I think that is important to also take into perspective is just the difference in terms of how popular investing is now compared to how it's been over the last 150 years. Like, investing is very mainstream, right? Like, you have all these platforms like Robinhood, robo investors, meme stocks. Like, it's just with the click of a button, right? Whereas you go back, to when Warren Buffett was doing research back in the 50s, he had to drive to the library to look at annual reports or have them like mailed in like one at a time, right? And I just don't think that there was the there just wasn't the level of interest, even just with the different financial products now, like the funds, ETFs, all these things. Like, it's not as household, or wasn't as household back then. So with more with more demand and not a commensurate increase in supply, you would expect then for the prices or the valuations in this case to be more extreme than they have historically. Just as another way of looking at it.
That's a
But
good
what I
point.
would also expect is, volatility as well, because when you start to get at those high valuations and people realize that they're based on expectations that are just completely, unrealistic or unfounded, once that realization sets in, we see some pretty abrupt reversals, like we saw coming out of the pandemic. After there is the pandemic, the tech boom in the pandemic, and then the complete obliteration of a lot of the stocks, many of which have not recovered since. I think that was 2022, right? Was the tech downturn, right? Like a lot of the stocks, many have recovered and gone on to produce amazing gains. Many have not recovered. So, and that's really where, from an investor perspective, valuation has to come in. Like, how ridiculous is it?
And this is one, like, the precise reasons why we want to monitor the markets on a daily basis, and buy great companies when they come on sale if there is a downturn, because you're going to see more volatility with more participation in the market. You've got people in there who quite frankly don't know what they're doing, and then you get more volatility with the popularization of investing, and it gives you these opportunities that likely wouldn't be there if you had players with stronger hands in the market, to buy great companies on sale. Look at them like if you're going out there and you want to buy a car. If the car that you've done a bunch of research on, is a great vehicle for you going forward, if it suddenly came 25% on sale, you would run out there and buy that car. People have sometimes the opposite impression or effect when they see a stock go down 25%. If it's a company that we've got a ton of research on, and we like that business, we are there and ready to invest in it when there is the volatility. And we have seen more volatility in the past 5-10 years than you've seen, in the previous 100 years, likely in the markets. On an annual basis, you're seeing this monthly basis as well. So this is where you can take advantage of those great businesses. We were able to do that earlier this year in a company that we had liked for quite some time. It traded up to the $40 range. Fintech services the U.S. market and the U.K., and it dropped down to the $25 range when we had Liberation Day or around that point. Again, we didn't see any huge fundamental impact on their business other than general economic, and we were able to add it at a point where we likely would not have been able to buy if there weren't that volatility. So that's where if you're monitoring the markets, if you have a book of companies that you really want to buy and you see the volatility, take advantage of that, buy great companies when they come on sale.